These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will record the transaction related to the purchase of equipment with debt into our bookkeeping problem in Excel, keeping in mind how the same information might be put into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. First, we will take a quick look at QuickBooks and then jump back to Excel to enter this information. If we enter this into QuickBooks, there's a couple things that are a bit different about the purchase of equipment with debt. One, purchasing of equipment is usually a large thing. We're purchasing something that has a fairly decent dollar amount, and therefore it doesn't happen all the time. So it's not something we see as readily on the home page. We may not just be running through the normal purchasing process in the home page, and therefore we have to go somewhere else, and that's a little bit more unusual than just the day-to-day transactions which happen all the time, and therefore there's a set process for them that we see readily. The other thing that's going to be different here is that we're dealing with debt, meaning we're purchasing it and we're financing it, and therefore if there's no cash affected, we're not just going through the check register, or as we could do if there were cash affected. And so it's a little bit more complex most of the time for us to enter this information into a QuickBooks system. One way we could do it is with a journal entry, which is in essence what we will do in Excel. But QuickBooks, oftentimes they try to build things in so that we can put data in without knowing journal entries. And most of that is done, as we've seen, with forms, so that invoice and the bills and whatnot are attempts for us to be able to simplify the process so that once set up, we can just enter that stuff into the forms, and then it'll flow through to the financial statements. No set form particularly for a purchase of equipment because it's more of an unusual transaction. So we could go to a register and instead of choosing the check register because we're not paying cash, we can pick, say, the furniture and equipment register. And it would be much like a journal entry if we were to do that. This would be the furniture and equipment register. And it looks kind of like a check register, except for the fact that when we see these increases and decreases, it means increase and decrease to this furniture and fixture account. And therefore, we're going to say that we're purchasing something from Office Depot. There's an increase, not to cash, but to this particular account. And then the other side is going to go to loans payable. And by doing that, QuickBooks can basically figure out the debits and credits by this increase and decrease type format. This works for types of transactions that have maybe two transactions. It gets a bit more difficult to not be using debits and credits when we get to transactions that have 3 or more items, but it's still possible to do it. I'm not sure exactly if it's a lot easier to do that than to do a journal entry, but since we're working this and showing the QuickBooks side, we'll show how to do it, working around doing the journal entries, meaning working around knowing debits and credits. And then we'll see the debits and credits when we go to Excel. Let's do that now. We are now in Excel and we're going to record this transaction. So we're going to be purchasing equipment with debt. So if you were to see this in like a book problem, it would be like purchasing equipment on account or purchasing equipment taking out a loan. And the first question then, of course, is always, is cash affected? And we're going to say, in this case, no, because we're purchasing it on account, meaning we're buying some type of equipment like a forklift or something, and we are financing the entire thing. So if that's the case, typically I like to think about what we got. What did we get? What did we receive? Because sometimes it's easier to know the debits and credits if we do that first. We got furniture and fixture. So we got this item here, furniture and fixture, still an asset, has a debit balance. We're going to make it go up by doing the same thing to it, which in this case would be another debit. So I'm going to copy the furniture and fixture. We'll put that on top of our journal entry. Scrolling back down to the next available location, it's still 228. A lot of activity on the last day here. We're going to say right click and paste 1, 2, 3. The amount is going to be for $5,000. We're going to credit something as well for 5,000. And the credit will not be to cash because we didn't pay cash. It's not going to go to accounts payable because it's going to be more of a long-term debt, meaning we're probably going to be financing it, probably have to pay interest on it and have a formal written contract for it. And therefore, it will be going to loans payable. We're first going to start off with all loans payable in the long-term loans payable or one loans payable account. Later, we will be breaking this out to a short-term and a long-term portion, a current and a long-term portion as part of our adjusting process. So I'm going to go ahead and copy this loan payable. And that will be then the credit. That's going to be in Q33, right-clicking and pasting 1, 2, 3. We'll then format this by selecting this item and go into the Home tab. We're going to go to the Alignment group and increase the indentation. We have now journalized the journal entry, and we will go through the process of posting the journal entry to the general ledger. Before we do that, we're going to freeze the panes if they're not frozen already. So I'm going to scroll up to the cell of AJ1, and then we'll go to the View tab up top. We're going to go to the Windows group within the View tab. Select the Freeze Panes, and we will freeze the panes, lessens the pain of posting. Scrolling back down, we're going to post this last transaction that we have, starting with the furniture and the fixtures. Furniture and fixtures. That then is here, the last green account on the trial balance, last asset account that is, and therefore will also be the last green account or asset account on the general ledger. I should say green account and asset account. We're going to scroll over and find it. Scrolling over to find the last green account and asset account of furniture and fixture, found it in AY8. So we are in cell AY8. We're going to scroll back down and we need to pick up that 5,000. So what we're going to do is we will be saying equals, then we're going to scroll down just a bit and click on that 5,000. Let's do that now. Scrolling back up, we are clicking on AY8. We're selecting equals. We're scrolling down just a bit and picking up that 5,000 and enter. So that has increased the balance from 98,000 to 103,000. Let's see if that's the amount on the financial statement, as we hope it will be. We see the amount 103,000. Scrolling back down, we are out of balance by the 5,000, and notice that there's no effect on net income here. Why? Because we're capitalizing the equipment, meaning we're not just going to expense it, and even if we paid cash, we wouldn't just be expensing it at the time of purchase because it's a long-term asset that we will be using over a long period of time, and therefore will be depreciating over that period of time. Next, we have the loan payable. So loan payable is the next account we will be posting to. That's down here. It's the last orange account. We had the last green account. Now we're doing the last orange accounts. So we're going to find that. That's the last liability account. Scrolling back over, it's going to be in the same order on the general ledger. Here are the green accounts, the assets. Here are the orange accounts, the liabilities. It's going to be down here somewhere. It's going to be down here possibly. Unearned revenue, no, I was wrong. It's going to be at the top of the next column. There it is. So we want a credit. So we are over here in BH10. BH10. And we're going to scroll. Maybe I should go over a little bit more and put it side by side here. Let's put this side by side. We're still in BH10, but we're side by side now. And now I'm going to scroll down and we need to pick up that 5,000. So what is going to happen is we're going to be in BH10. We're going to select equals. We're going to scroll down just a bit and select that credit of 5,000. Let's do that now. We are now in cell BH10. We're selecting equals. We're scrolling down just a bit, selecting that 5,000 and enter. So there we have it. The balance goes up from 69,879 by 5,000 to 74,878. Let's see if that 74,878 is the amount on the trial balance, as I believe it will be, and hope that it is. Scrolling down, we see that 74,878. There it is. That puts us back in balance. No effect on net income from this transaction, not because we didn't pay cash, but because we bought furniture and equipment, which has not been consumed yet, and we will be expensing it as it is consumed in the format of depreciation. We'll see that in the adjusting process at the end of the month. For now, let's first unfreeze the panes and then go look at the financial statements and see if this has populated automatically as it would in accounting software. We're going to the View tab, the Windows group, the Freeze Panes within the Windows group, and we will unfreeze the panes because we no longer need to post. Scrolling down, we're going to see what we did something to the last asset account, I recall, was the furniture and fixture. I'm going to point that over to the financial statements. And we did something to the last liability account, the last orange account, so we're going to point that to the financial statements. And then we're going to take a scroll to the financial statements all the way to the right. So we're just scrolling over the right and see what happened to them. Hopefully they've been updated automatically. There's the furniture and equipment, and there's the loan payable, and we are still in balance. Assets still equal total liabilities and equity. That is no effect on the income statement. Still seeing that net income of $8,161. That same amount on the statement of equity as well. Part of the calculation for the ending equity of $152,336. That found as well on the balance sheet. Hello, in this presentation we will record the purchase of music equipment with debt. In other words, we're going to purchase $5,000 worth of music equipment and finance that equipment within QuickBooks Pro 2018. If you've been continuing along with us, we will be working with the Get Great Guitars problem. If not, that is okay. We will demonstrate the purchase of equipment through financing. We currently have the Home tab open. If you don't have the Home tab open, it can be found under Company and Home Page. We also have the Open List open over here, Open Windows. That can be found at the View tab and the Open Window List. If you have the backup to this point, you can restore that backup by going to the File tab and restoring the backup. That will get us all to the same point so we can put in the same information as we go forward. Currently, we are going to be entering equipment. We purchased equipment, we financed it. A couple ways we can do that. We cannot do that the traditional way, however, and that is that we would just basically write a check for the equipment or possibly enter a bill and then write a check at a later point in time, because the financing is going to be a bit longer term. So if we were, for example, to create a bill for it, it would go through accounts payable and we would create a liability. However, it wouldn't be in notes payable and we wouldn't be recording interest on it. We can't write a check or simply put it into the check register as we normally do. Most of our journal entries we've looked at are driven by some of these forms, or we write a check for it and that makes the journal entry for us. We can't do that at this time because there's no cash involved in this transaction at all. So we're going to have to fall back on some other method. One method is obviously we can make a journal entry for it. So this is one of those types of transactions where we might have to look at debits and credits. If we understand debits and credits, then we can just make a journal entry and put it in the general journal. The way to do that would be to go to the Company tab and make journal entry. And if we were to do that, we bought equipment on account, we would just debit the equipment account and credit the loan payable, increasing the amount of equipment and increasing the loan. If we don't want to work with debits and credits, however, QuickBooks does give us other options that we can use as well, and that would be the registers. So if we go into the banking option, and that's what we'll work with now. So we'll do the same thing. It'll be a journal entry. Everything we do in QuickBooks, most things, is a journal entry, or QuickBooks makes a journal entry through what we do. But this is going to be a way that we can do it by saying increases and decreases rather than debits and credits. So if we go to banking and say use register, we usually use the check register, but we can actually see a register for any type of account we want to look at. If we're going to be purchasing equipment, we could go to for debt. We can go to any of these two accounts. We can go to the equipment account or we can go to the loan payable account. Either of those two accounts will work. If we go to equipment, we're going to say that we're going to increase equipment and the other account will be loans payable. If we go to loans payable, we're going to say we're going to increase loans payable and the other account will be equipment. Let's see what that looks like. I'm going to go to the equipment account. That makes more sense to me. So I'm going to say furniture and fixture. That needs to go up because we bought more of it. So I'm going to click on that, and we're going to see a register when we select OK for that equipment account. Probably not too much activity in your equipment account activity because you're not buying and selling equipment every day. If you were, it wouldn't be equipment, it would be inventory. And therefore, there's probably not so much action going on here. But note, all we have are increases and decreases. So I don't need to know that I need to debit the equipment account to make it go up this way. We can just put this information in terms of increases and decreases. So we're going to put the date. I'm going to say 02/28/21, the end of the month that we are working on in the year 2021. And we're going to say that we're purchasing from Office Depot. And we already have this vendor here, so we're just going to type that in. There's the vendor. We are going to increase the equipment. So it's not in terms of debits and credits. It's in terms of increasing and decreasing. Us being in the furniture account, we're going to increase the furniture account by $5,000. And then we just need to add whatever other account is affected. That other account happens to be, in this case, us financing it. We're going to put that into an account called loan payable. We already have a loan payable set up here. So if we scroll up, it's going to be an other current liability. If we start typing it in, loan payable, there it is. If you were to set up a loan payable, you would want to set it up as either long-term or current liability, depending on the terms. We're going to say here it's going to be a long-term liability, and that's how we're going to set this up. So if you hadn't set it up, you want to type in loan payable tab, and then set up the account as a long-term liability for that. So we're going to tab through this. It's also possible, note, that we're going to record all of our loans into this loan payable account. And if you have multiple loans, you might actually want to list out the loans separately on the trial balance and have the loan number so you can track them separately with their own line items. And then when you make the financial statements, you might want to group them together all in one line item called loans payable. In this case, we have few loans. So we're going to put them all into our one group of loans payable. And note that it does not record unless we hit enter to be on the next line. So we should say enter. Now it's on the next line. What's this going to do? It will obviously increase the office furniture or account, the accounts we are in, by the $5,000. And it will increase the loan payable by $5,000. Let's see if that's the case. We're going to go to our reports and check that out. Reports drop down. We'll start off with the balance sheet. We're going to go to company and financial. Scrolling down to the balance sheet, standard format. Going to change the dates by going up to the top and customize report. And we will then tab through the dates and go to 01/01/212, 12/31/21. So January 1st, 2021 to December 31st, 2021, and OK. There is our report. We didn't pay cash for this. What did we buy? We bought furniture and equipment. That's going to be here. So we'll double click on that item. And we see the furniture and fixture there. There's the $5,000. Double clicking on that, we get back to our register where we have input this information. Closing this back out, closing this back out. We're going to go to the other side, which is not going to be an accounts payable, but loans payable because we financed this item. And we do have other loans out, apparently. So we're going to double click on the loans payable, and grouped within the loans payable, we have the $50,000, and we now have this $5,000 here within the loans payable. We're going to double click on that, and there is our amount again. So the loan is on the books. Note that when we think about this in terms of financial statements, we do have to consider whether or not how much of this loan is going to be short-term, how much of it is going to be long-term, and when we create the financial statements, we'll have to see how much of the principal will be paid in the current portion and how much of it will be paid in the long-term portion to adjust for this loan payable.